Okay guys, we're back with another video here. I wanted to make a quick video for you. One, because I haven't made a video in quite a while. I know a few of you have been hitting me up wondering, hey, where you at? Well, life has been happening. I'm actually moving to a new spot in about a month that I just locked down. So things are exciting, things are looking good. But I've seen a lot of you guys, struggling over the last, I don't know, 3 weeks, 4 weeks, 5 weeks. A lot of messages in my DMs. And so I want to make this video to try and help you guys out, specifically talking about how I've been using volume profile in addition to all of my ICT methods to really be crushing the last few weeks. Now, I didn't invent anything new with volume profile. What I'm going to describe is not something that you probably couldn't find if you were searching on your own. But the purpose of this video really is how you can utilize this method with ICT to really supercharge your entries. Now, I've studied ICT for years, okay? I know all the concepts, and I know Michael really doesn't think that volume is that important, right? The whole idea is that price trends on an algorithm is going to go where it's going to go on low volume or high volume. Look, we're not here to argue that. What I'm here to show you is if you're looking at an order block, if you're looking at an OTE entry, if you're looking at a standard deviation projection, how you can align that with the volume profile to either get a much stronger confluence, to have extremely high confidence in your area where you might be looking to take profit or enter a trade, or if you're looking at an area where you might say, hey, look, price can slip past where I think it'll go simply based on volume profile. So let's hop right into it. So looking at this chart, I'm using Quantower here, which is my preferred trading platform for all my Rhythmic accounts, like my Apex. With this, I'm drawing the volume profile specifically from the low right here to the high right here of the previous, what I would call the dealing range, right? So this is a fairly large range. This works on all time frames. The way I use this technique is when I see price expanding higher and then start the retrace and start to come down, it could be coming down to 50%, it could be coming down to OTE. We don't really care about that. All we know is, okay, look, price has reached this area, whatever that is, it could be a higher time frame level, and it started coming down. So you're asking yourself, you're saying, okay, where can price go? A lot of us are trained to use fair value gaps. You guys know that I love untapped fair value gaps. They're extremely powerful. When it comes to order blocks, what makes an order block so good, truthfully, is the overlap in volume, right? An order block can serve as an area where price has gone up and down, sometimes just once, sometimes a bunch, in a short range of price. Now, price, in my opinion, is three-dimensional. And what I mean by that is you have the x-axis, which we all know as time, days and time. And then you have the y-axis, which is price. And then you have what I consider the z-axis of just sort of external factors, right? Whether it's a tweet, whether it's news, fundamental news, whether it's higher inflation readings, etc. So you as a trader are trying to match up the x-axis, the proper time, with the y-axis, the proper price, along with the right fundamental or news catalyst environment. Those are going to give you your best trades. So what volume profile can help you do is align the price component of the trade. Usually, like I said, for ICT traders, we're using fair value gaps, untapped fair value gaps, breakers, the whole PD array matrix. When it comes to volume profile, specifically using the low to the high of the most recent range. I don't care about the session volume profile. I don't care about the day volume profile. I don't care about the last year's volume profile. We only want the last trading range. It will help you align the proper order blocks, the proper fair value gaps, the proper levels in conjunction with a PD array that might overlap to get a really good bounce. So let's zoom right in here. I can't really change the time frames that much because, as you guys all know, with Rhythmic, over the weekend you can't really get new data in on your chart. So right now from the week I've had 15-minute charts pulled up. So we're gonna stick with the 15-minute, okay? So when you look at the low to the high, I'm drawing, and I hope you can see this blue box right here I'm drawing my volume profile to only show me the volume in this area. Now, as you guys know, when it comes to volume profile, this has been taught for decades. You're looking at the high volume nodes signified by the spikes in volume as obviously the areas where you've had the most volume being traded. So as price is coming down, what you'll notice is on these areas that will be order blocks in the higher time frame, I'm going to quickly show you the same range here on the 4-hour chart in trading view. All of these order blocks here and here and here, also these right here, they're all potential bounce points where it can be a slight retrace back up, it could be a sharper retrace. How do you know which one is the most important one? Now, ICT, Michael, he has a bunch of techniques you can use. I primarily like using standard deviations, but with the volume profile, it can be one extra layer that's extremely accurate, probably only surpassed by projections if you use them correctly. So as you can see right here, price makes a high. It starts coming back down. Where does price bounce first? Okay, first you see price do a little bounce up right here at this high volume node, and keep in mind this is only the volume. I've said this probably 5 times, only the volume from this low to this high. So this volume is not accounting for anything that's happening after this high. So price comes down, makes a little bit of a dip right here and gets a nice little retrace. This happens at this volume node. Price then continues down. Where does it bounce? It bounces almost exactly at the spike in volume. And this would be the point of control for this whole price leg. But it happens right here at this large spike, this nice big volume node right here, and then you get a nice little move up from 59.08 all the way up to 59.58. Now look guys, if you're trading ES, if you're trading micro ES, 50 points will make anybody happy. Any trader who says 50 points is not enough for them is a clown. So how could you have capitalized on this trade? You'd say, hey look, price is coming down. Maybe I get in here with a really nice sniper entry off of a higher time frame level, and I want to get my take profit set before this level right here. So you might set your take profit, at 59.15, expecting price to gravitate towards this specific high volume node and then get some sort of reaction. Or you can be the guy who's saying, hey, look, price is going to come down to this high volume node. I want to be the guy who's placing a buy order here, putting my stop below this low for a nice little pop back up, which can be expected. That's how you utilize this. So look, price keeps coming down. Where does it hit? When it hits right here, oh look, there's another high volume node right here. A lot of you guys are looking at, who strictly trade ICT. Keep in mind, 85% of my system is ICT. I love the method. This is what I use daily. But a lot of you guys are sitting here as price is coming down, and you're only looking at these lows right here. You're saying, oh, look, there's some 15-minute relative equal lows. Well, look, price comes down and you get blown out because price is a retrace from 847 all the way up to 874. Maybe your stop can withstand that, but if you're on the lower time frame, the 1 minute, trying to super scalp that, you're going to get blown out unless you have no risk management and you're just free balling it, right? So when price comes down, where is it bouncing? It's not bouncing at the liquidity. It's bouncing at a higher time frame order block, specifically at a level of high volume, okay? So then price comes down yet again, and where does it bounce this time? Almost to the tick, guys. 828, almost to the tick of this area right here, which is another high volume. Now, keep in mind, I was showing you here, these are all the order blocks that are stacked up. We can expect as traders to get reactions from these levels. Everybody knows that. Every ICT trader knows that. But the X-ray view into the order block comes from where the volume sits. I'm here today to tell you, for years, a lot of you guys have thought volume doesn't matter. Volume matters, okay? It matters. Whether or not you believe there's an algorithm, look, we all know there's thousands and thousands of little algorithms that control the market, okay? We all know that. But what a lot of ICT traders believe is that there is one universal algorithm that is dictating where prices go. I simply do not believe that, okay? What price is doing is it's navigating two areas where most participants are aligned for something to happen. So hypothetically, let's just say you had 1,000 algorithms in the market, right? And there's tens of thousands of them, but let's just say there's 1,000. If 800 algorithms want price for whatever reason to come down to this area, then this is where price is going to go. If there's a lot of volume, a lot of participation. If 800 of the 1,000 only want price to go down to this area right here, then this is where price is going to go. There is no universal algorithm that says price is going to surpass all these levels and go down to this exact level down here because that's what's going to happen. That doesn't exist, guys. And I'm sorry, I hate to break it to you, but there are a million traders out there who, no matter what price does, it goes up 1,000 points, they say, oh, look, I called a 1,000-point move. That same exact time, there were 1,000 traders looking to short. And if trading goes down 1,000 points, the day goes down 1,000, they'll say, oh, I called the move down 1,000. So when you guys go online, when you guys look at your gurus who are calling moves, for every one guru who calls the right move, there's another guru who's calling the wrong move, okay? For every surprise move that shoots up 10% on a stock, there's another guru who is calling for a 10% drop. You only are going to hear from the majority of people in that one instance who were correct. And it leads you to believe that the people are going to think like, okay, look, this guy must know what he's talking about. This system must always be 100% accurate because I'm always seeing people, whether it's long or short, calling the market to the tick, okay? But I'm here to tell you that, yes, we can be profitable traders, but there is no one system that exists in the world that's 98% correct, that offers good risk reward. It doesn't exist. So for you guys who are out there who believe that just trading ICT will allow you to harness the power of the master algorithm to call the market down to the tick using just candlesticks, using just time, it doesn't exist. And the funny thing is, every time it's wrong, whatever this master algorithm is, people say, oh, it was, human intervention. Oh, it was a Trump tweet. That's just not true, guys. It was the market being the market, and it simply didn't align with your thesis for that day, your thesis for that session, okay? So what I'm showing you here today is true volume in the market that you can align with all of your ICT strategies, whether it's a breaker, an order block, a fair value gap, whether it's a rejection block, okay, guys, a mitigation block. All your stuff can be aligned with this concept to find an increased probability that the market's going to bounce. I showed you right here. It bounced at an order block. Let's look at this level on the 4-hour, okay? This is 5828.25. To the tick, the market bounced. It happened to be a high volume node on the move up. So let's look at this, 5828. Let's see what's going on here. You see that tick right there, boom, 5828. Let's make it. So here we're coming down. Sorry about that. We're coming down. We're inside of a 4H order block. So there's gonna be a lot of people out there who are saying, okay guys, look, we swept these little lows here. We came down to an order block and they're looking to buy. Is that a bad decision? That is not a bad decision at all. So people who are trying to do that are, let's see how a trade might actually look in this scenario, right? You're coming down, you're saying like, okay, look, I swept some liquidity. I'm coming down to an order block. You're looking at the entire order block zone as being from, let's just say the blue, okay? Some people are looking at the entire, they're looking at this entire range from the top of the candle. But I think most of you guys who have studied ICT for a while, understand that you really want to look at the order block at the body, okay? So this entire range here could be the order block. So you could be looking at placing your long entry. This is just an example, okay? This is if you want to take a trade here. So you could be looking at placing your buy, at the body, like a lot of people do, placing your stop, let's just say at this low, or, you could say at the swing low. Both of these are fine. And then you're targeting whatever you're targeting, right? Maybe you're targeting this untapped fair value gap, which I teach, and it's amazing, right? So here's a 1 to 5 trade that I would consider to be a good trade. Now, and then if you were to shorten it, it'd be even more. You're looking at 3R, which is great. So this is a great trade using just ICT, using just an order block, no issues there. However, if you were sitting here thinking, okay, look, 5828.25 is the high volume node that we've identified right here. I expect price to come down very, very close to that and then bounce. What you could do is, instead of being at the body like most people, you could lower your thing down. You could lower down to 58, let's just say 29, 58, 30. Once you get that bounce, maybe you have it right at the body here. But once you get that bounce up, you could go break even immediately. So you've turned a 3R trade, even staying below, let's not be crazy here. Staying below the body of the order block, you've turned a 3R trade into a 5.8R trade, which is great. Taking the same exact trade, except you're looking at the laser pinpoint zone right here. So let's just say you also add in standard deviation projections on NASDAQ. And let's hypothetically say, I would show you a NASDAQ chart, but I don't have it pulled up right now. And like I said, I can't get the data right now because it's the weekend. Let's just say you were coming down and you had a high volume node lined up with a 2.5 standard deviation or with a 4 standard deviation inside. These are usually almost always inside of order blocks, inside a higher time frame order block, and it was the right time of day. Like this is 7:30, but let's just say it was 10 a.m. or something. That would be an extremely high quality trade that you could take. And the beauty of this is you can have a tighter stop loss because you have a better entry. You're not sitting here looking at the entire order block zone. And I see this all the time. I've been seeing it for at least, I'd say like 3 years now. Traders will be frustrated because they'll say, I'm looking at a daily order block zone. It's huge. How do I navigate inside of a daily order block? And then people will say, okay, look, you go down to the lower time frames, you find an order block within an order block, maybe you find an inefficiency within the order block. Those are all true. That's how a pure candlestick trader should do it, right? You would go from the 4 hour down to maybe the 5 minute, and you would try and find a level there where you expect a bounce, maybe a breaker within the 4 hour, etc. But what if you just took the volume? The volume profile is going to be the exact same, whether you're looking at a daily chart over the same range, right? Whether you're looking at a daily chart, whether you're looking at a 1 minute chart. So that high volume node will always be 5828.25. So I think you guys are getting it. I'm not going to hammer the point home. I'm going to show you some more examples. But I think you guys are getting the idea that this is just one added confluence that will help you in these zones find out what is most important. It'll help you set your partial levels, because instead of just partialing, let's say you went to partial here, okay, at this liquidity, maybe you could have held it and partialed a little bit lower when it bounced off the high volume node down here, okay? Instead of getting out prematurely, you could say, I need to go for a bigger move down to a lower value here. So maybe once we crack this high volume node, you can be extra bearish. You could add to your position, right? You're up here, you're thinking about shorting. In your head, I've got to come down and get through this, okay? It takes the market some time. I got to get through this high volume area before I can see an additional sell-off down to this high volume node right here or this one right here. So maybe you enter position up here using your standard ICT patterns, price comes down and you say, okay, look, I'm going to take something off the table here. I'm going to partial expecting a bounce. So let's say you partial off half your trade. Now your stop up here could be break even. Then you see the trade come back down after this retrace and pierce through this high volume area, giving you added confluence that we're going to see a continued sell-off. So now you re-enter your position. You already had part of it off. Your stops break even. Now you bring your stop down to this high, you add into your position, and then you go down and you attack the next high volume node. And then you partial here because you say it's going to bounce right here due to what I'm seeing here. I'm going to partial, and then I'm going to partial again right here, etc., until you get that final reversal or until you're just happy with your profits, okay? Now, we're doing the same exact thing right here. I want you guys to really see how good this is, okay? So here's another price leg. We're measuring from the bottom to the top. We're not looking at any of this information right here just yet. I'm going to show you what this looks like when I add that in. But here we go. You get up here and we're like, okay, look, I want to take a trade from up here, potentially going down. What could I be looking at getting out for a take profit? So price sells off. What happens when price comes back down and gets into this area right here? Now, look, ICT traders, we're sitting here saying, here's a 15-minute breaker, right? This whole area right here is a 15-minute breaker. So a lot of you guys will be looking to exit, partial, etc., which is not a bad decision. What I'm proposing is, if you were to come down to here, you see how price kind of gets a little bit, congested here because it's hitting this high volume. It comes down lower. Once it cracks through this area right here, it goes to this, I hope you can see it. There's a high volume area right here. So these high volume areas, they're kind of all over, right? Like here's a high volume node. Here's another high volume node. Here's a high volume node. So by itself, you can't sit here and say, oh, look, there's a high volume node. What you really want to do is find high volume nodes that are in discount, and you want to find the highest volume nodes as the biggest draws. Okay, those are kind of the two things you want to look at. So as price is coming down, we hit this high volume node right here and it bounces almost to the tick. I'd say this high volume node peaks right there at 885.25, and then price comes down and it goes, a couple of points below it. If there's 885 right here and price goes down to 883.75, that could potentially give you a beautiful take profit level. It could give you a beautiful retrace trade back up. There's a lot of ways you can play with this. Now, look right here. You're coming down and you're thinking, okay, this price right here could come to this high volume node, but we have a ton of volume sitting right here. Now, this volume is not part of the run up. It would not be in my initial sort of volume profile the way I do it, from the low to the high or the high to the low of the range. But when you add this in, everybody knows that these congestion areas, this is a higher time frame breaker, okay? When you add it in, look what happens. Boom. Just adding in this consolidation range, you get to the tick, guys. Like I'm trying to tell you, man, this is crazy stuff that I want you guys to all start using, okay? People have been trading volume profile since before I was born. I want you guys to understand that you can add this in with ICT and it works wonders. Price flushes down. This happened on Friday, and it comes right down just past the highest volume area of this cluster. Now, if this was a normal move down, because usually, when you get a move down, it'll just kind of go down, hit a higher time frame level or an internal imbalance, and then go up. You wouldn't need this, okay? Like this wouldn't matter. So 9 times out of 10, I'm not including this consolidation. But when you have an up move and it's retracing and you have consolidation that formed a PO3 pattern, right here we had consolidation, manipulation, and then distribution, it's important to be aware that this is a very, very high volume node that should have some type of reaction. And you see the reaction happening exactly. So this whole video, guys, I'm going to wrap it up real soon. The point of this video is, by adding in volume profile, there should be an indicator on TradingView. I haven't used any, but I think I found some that do this exact same thing, just not as nice, for free on TradingView. So you guys can start implementing this, next week. By using the volume profile in conjunction with your ICT PD array, you will be able to get much, much better entries. Your stops will be able to be placed in a much better area because you could just put a stop right here below the high volume node. So if you were trying to take this trade, and keep in mind, guys, look, no trade is no trade's 100%, okay? This is not some system that you're going to be like, wow, I don't miss trades. What this is going to do is give you a chance to get into trades that are very high quality, that will have much better entries than you blindly shorting or longing from just below liquidity. Like I said, you want to take this and pair it with your projections, pair it with your internal liquidity imbalance areas, pair it with external liquidity ideas. But when you notice that you're pulling into a high volume area, your alarm bell should be ringing, like this could be setting up a really nice trade. So in an example like this, let's just say you had your the entry to your trade. This is a beautiful little liquidity level here, right? A lot of you guys would be looking at that. So let's just say you wanted to enter long right here at when it took this liquidity, okay? And it's kind of coming down into these imbalances. It makes a lot of sense, right? This will make a lot of sense to an ICT trader. And then you could just put your stop below this high volume node, kind of here in the little valley area, like right here. And then you could target, a lot of people were looking at these highs on Friday. You could just, target the highs. And this trade right here is a 4.86, almost a 5-to-1 reward to risk trade, just using the volume node. And then guys, what do? Okay, like price will come down, maybe it stops you out. Maybe price just wants to dip down just a little bit lower and come down into this fair value gap right here, this bullish fair value gap. And so that's fine. That'll happen. So you're going to lose 1R on this trade, and then you're going to set up your next winner. You're going to come down and say, look, there's an imbalance here. I'm going to target the top of this node. I'm going to put my stop just below it. So I call below it kind of, like this area here. Once you reach into the valley, right? So, put a stop right here at 22.75. And then you're targeting the same area, guys. So you're stopped out 1R. You re-enter here. You have another 5-to-1 reward risk trade, and you take it. And that one's going to be a winner. And then you're like, okay, oh man, it came down even more. Okay, it stopped me out again. But for whatever reason, you're bullish. Okay, what do? It's coming in. Maybe it wants to fill this entire imbalance. We've all seen that happen a million times. So you're sitting here and you're thinking, okay, the imbalance ends right here on the 15-minute. I'm going to put my entry just above the end of the imbalance, just above the high volume node. We're going long again. We're targeting up the highs again. And then where's my stop going to be? My stop might be below. I hope you guys can see this kind of 15-minute order block, right? There's like a red dip right here. So my stop here is below the red, or just below this kind of cluster of price where it'd have to break through all of this. So now this one will be a little bit worse, but it's a 3.8. So you could take all three of these trades. You have two really good trades, and then you have this trade right here. You're keeping the same dollar risk of 1R. Let's say your 1R is $500. $500 loss. $500 loss. $500, and then you got right here $500 times 3.8. We'll say 500. We'll essentially say 500 times 4. So you lost 500, 500. You're down 1,000, and then you get a 4-to-1 right here, and now you're up 2,000 on the trade, and you're up 1,000 on this move. You're up 1,000 on this idea, and then net you're up essentially 2R on this idea. Just in a general sense, right? If your risk is 500 and you've taken these trades, and then you end up with 1,000 on the day, you could walk away from the day saying, hey guys, look, I'm up 2R on the day. I took 2 losses, but using these areas in conjunction with the PD array matrix, if I was bullish, if the timing of the day lined up, then I could take these trades with relatively tight risk. The last one, I agree, would be worse risk reward, right? It's a little bit bigger, but with tight risk, you're coming out profitable. So I hope you guys can dig into this. I've been using it for weeks now. I've been absolutely slaying the market for the last couple of months using this. Despite the ups and downs and the craziness, I've just been getting into trades using this volume profile in addition to all the other things I've taught you. Nothing else has changed from that system. But I've been adding in volume now for months to my trades, and it's helped. I've been adding in the volume profile now for quite a while, and it's essentially the x-axis volume, on steroids. And like I said, guys have been using this for decades. This is nothing new. I didn't invent a single thing regarding volume profile, but I want you guys to start utilizing it from the low to the high, not the full day, not the full session, not the full chart view. That's all nonsense. From the low to the high, if you see some consolidation before that low to high swing, add that in as well, and then use that to align the different PD arrays. Use that when the timing is correct, right? Use that when you see a PO3 pattern. Use everything else you already know with ICT, but this is going to make you guys super sharp, okay? Out of everything I've ever learned about trading, when it comes to accuracy, standard deviations for me are the most accurate thing, period, bar none. Nothing comes close. And second to that, guys, is volume profile. We already know where price is going to turn when it hits breakers, when it hits fair value gaps, when it hits order blocks. All ICT traders know when to look for longs, but a lot of guys have horrible risk reward. They don't know where to put their stops. They don't know where to put their entries, so they put it at the top of the zone all the time and then have to suffer through drawdown as it digs deeper. Well, this is telling you guys, this is telling you how deep price is going to dig into your zone. So enjoy it, have fun with it. It's an amazing tool, and I wish 5 years, 6 years ago, I started using this. ICT trading made me profitable, but I've been navigating these crazy market conditions with the volume profile, and it's been nothing short of being a game changer to an already amazing system that I've shown you guys using untapped fair value gaps. So, all right, that's it. Catch you guys later.